Hello, everyone, and welcome once again to another edition of the Money Pros. I'm Oliver Tutt, certified financial planner practitioner, and I'm going to be your host for the next half hour as we talk about the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. We've got a great show on tap for you today, a long list of things we're going to touch on. First of all, we're going to talk about President Obama's new retirement plan proposal called the MyRA. We're going to give you details on what exactly it is and how it might fit into your financial planning and your ability to save for retirement. We've got a special guest joining us today. His name is Rich O'Brien, and he's an independent insurance agent, but he's got a specialty in a type of insurance that a lot of consumers don't know a whole lot about, and that's supplemental medical insurance. So we're going to be talking to Rich in just a little bit. Now that spring has sprung, we're going to be talking about not how to spring clean your house and your garage, but how to spring clean your personal finances. What are some things that you can do right now at the beginning of the year to help get your personal finances in order? And finally, we know that raising children is expensive. Just how expensive is up for debate, and the Gallup organization is out with a new survey with their take on exactly what it costs to raise a child, and as a father of 4 children, I think it's something worth taking a look at. So we're going to do all that today, but starting out, we're going to talk about President Obama's proposal for a new retirement plan, and that's called the MyRA. In my opinion, one of the more cumbersome names for a financial product that I've ever heard, but I think it's got some admirable goals, and we want to talk about them. So during the State of the Union address in January, President Obama, among talking about many things, foreign affairs, domestic policy, and things like that, talked about something that's near and dear to my heart, and that is retirement planning. The federal government, as many of us are also aware, is very aware that Americans are not doing enough to save for retirement. And President Obama announced his plans to start a new type of retirement account called the MyRA, and we want to take a look at some of the details. But first, why do we need this type of plan? We have documented on this show over the years how poorly Americans do on average of saving for retirement. And we can take a look at some government statistics. In fact, here's a graph that is from a survey done by the federal government several years ago that talks about the percentage of households with a retirement account. And it's broken down by age. So if you look at household income earners, age of the head of household, 25 to 34, just over 40%, 35 to 44, just over 50%. All households, just over 50% of all households with an income earner actually have a retirement account. So the MyRA account is an attempt to get more people to save for retirement by making it a little bit easier. So let's take a look at some of the features, proposals for the MyRA account. First of all, eligibility. Household income under $191,000. So as long as you're not one of the 1%ers with an income for your household over $191,000, you'd be eligible to start a MyRA account. Next, tax treatment. Of course, this is something that the federal government can do to incentivize people to save for their retirement, as they do with many other types of retirement accounts like 401ks and IRAs. Tax treatment for the MyRA account will be similar to a Roth IRA. So what does that mean? It means when you put money in, you don't take a tax deduction for it, but when you take the money out, including all the interest that you may have earned over the years, you won't pay taxes on that interest. So that's a pretty good incentive. Third, minimum $5 contributions via payroll deduction. This is targeted at beginning savers to make it as easy for them as possible to put away money. So a minimum $5 contribution via payroll deduction. The maximum contribution, similar to other IRAs, $5,500 a year, and there would be a makeup contribution that would bring that to $6,500 a year for folks that are old enough. Next, no account or setup fees. We've talked about on this show the fact that expenses are a major hindrance to retirement savings. These accounts would not have any setup or account fees. Finally, the investments limited to a government bond fund. So unlike 401ks and other investments like IRAs where you have to choose various investment buckets, mutual funds, things like that, this account is limited to a government bond fund. You're certainly not going to get rich from a government bond fund, but you can't lose any principal. So hopefully it eliminates one of the major objections people have often toward investing money. So that's the MyRA. For more information, check out our website at foxprovidence.com. And if you've got questions for us, email me at the Money Pros or at moneypros@foxprovidence.com. We'd love to hear from you. Up next, Rich O'Brien is going to be talking to us about supplemental medical insurance. So be sure to stay with us. There's a lot more to come right here on the Money Pros. Welcome back to the Money Pros. I'm joined now by Rich O'Brien. Rich is an expert in a type of insurance that I think a lot of consumers, and candidly I'll count myself among these people, doesn't know a lot about, and that is supplemental medical insurance. And I want to kick off our conversation by throwing up a slide, Eric, if you would. It's a statistic regarding bankruptcy as it relates to medical bills. Now, the first part of this is something that has been talked about a lot, particularly I think in relation to President Obama's healthcare initiatives and things like that. 60% of bankruptcies caused by medical bills, according to the American Journal of Medicine. This is a study that goes back to 2009. But here's the second part of it that I think is important. Of those bankruptcies, 77% of those folks had major medical insurance. So we're talking about people that have traditional, I imagine, Blue Cross, Blue Shield type of coverage, right?
Right.
And yet many of them are still running into problems. In fact, according to that slide, 77% of those bankruptcies caused by medical bills, and they had major medical insurance. I can see why the medical bills would trigger bankruptcy, but why would people that already have major medical insurance be in danger of bankruptcy?
That's a great question, Oliver. And some of the issues that are involved and so forth, one of them is high deductibles and co-payments and so forth. So some of the medical plans out there today, and again, these people work for major companies, they might have a $3,000, $5,000 deductible for their plans. And again, that's a tough nut, and usually a lot of people don't have that type of money in reserve to pay for that.
As costs have been going up for employers, they've been raising deductibles to make the plans more affordable.
Right, exactly. And so you have that, you have co-payments, just seeing the doctors and so forth. You might have specialists that cost you $50, $100 every time you see them. You know, ER medical co-payments are also up a couple $100. So that's one part of it. Another part people often don't think about either are everyday living expenses. So stuff like the mortgage, the rent, groceries, and so forth. You know, when you have some type of medical misfortune, whether it's an injury or an illness, you could be down and out, and that kind of leads to the third thing too, is loss of income. If you've exhausted all your vacation time, your employer's sick time, if you're fortunate to have that and so forth, you're not going to have any income come to the house to take care of those bills and so forth. So again, that's going to lead you down a path where you're going to, unfortunately, not be able to pay. And even if your spouse, heaven forbid, has to take care of you, if you have an illness such as cancer, has to take time out of work, and maybe that's unpaid and so forth, you might not have any income coming into your home.
So I think this is an interesting point. If you don't have the reserve funds to cover some of these things, and let's say you're a lineman or you work on a factory floor, I mean, it could be any number of jobs,
Sure.
right? And you break your leg skiing,
Right.
your major medical insurance is going to hopefully take care of hospital bills and things like that, but you're going to have deductibles that you're going to have to worry about. But you may not be able to go back to work for a period of weeks, and your health insurance is not going to pay for those things, right?
Correct.
It's not going to cover those bills that you talked about. So
Correct.
if major medical insurance isn't going to cover that, what type of insurance does? I mean, on this show, we've talked about life insurance, we've talked about annuities, we've talked about long-term care, we've talked about a lot of types of insurance, but I don't think we've talked about this scenario.
So this is where supplemental health insurance comes in and so forth like that. And there's a lot of different plans that are out there and so forth. And I can get into those in a minute and so forth. But what those plans do is give cash back to the individual, and you can use that cash in whatever way you want. You can pay the doctors and hospitals and so forth. But again, you're going to have people like banks knocking on the door because you need to do your mortgage payment. Mm-hmm. You can have landlords for rent.
So this isn't like my hospital submitting an invoice to the insurance company and them getting reimbursed, and I see a statement. But this is, I file a claim with the insurance company, and they're going to send me a check, and I can use that check for the co-pays. I can use it to pay rent, as you said. I can use it essentially for whatever I want.
Exactly. So you're going to get a check back from that insurance carrier, and then the check is made out to you, and like you just said, you can use it however you want.
Okay. So next question I have is, who are the major players in this particular field? I mean, I'm sure there are insurance companies that play in a lot of different fields: medical insurance, life insurance, annuities, things like that. But are there specific companies that really specialize in this type of coverage?
There are, and there's probably 4 or 5 big players and so forth. The first one is Aflac, which I represent and so forth. But that's the biggest supplemental insurance carrier. But there's other carriers out there too that are such as Allstate, Colonial, MetLife is another one to name a few. So those are probably some of the major carriers out there that offer these supplemental plans.
So when I see that duck on TV, I mean, that type of insurance is exactly what we're talking about, the supplemental health insurance. So
Exactly.
let's talk about some of the different types of coverage, because it's not one policy. There are coverages for a variety of different scenarios and situations. So can you run through, we don't have to go through every single, I think
Sure.
Buff set you told me there was 14 or more, but
Right.
what's some of the top types of coverage that people are typically looking at?
Sure. By far, the one of the more popular ones is like an accident coverage and so forth. And the nice thing about these policies, with the exception of short-term disability, is that you can offer them for your family too. So you can put your spouse on them, and kids are covered up to age 26, which is another nice thing about it too. So they don't have to be kicked off the plan at age 21 or 19 or what have you. So accident insurance would probably be the most popular one. I know in the Aflac world we pay more claims in that than any other policy.
Okay.
And the way it works and so forth, they're indemnity plans, and such that instead of giving you a monthly benefit like people use to short-term disability, it gives you a cash benefit depending on the services that are provided. So if you go, for instance, my daughter goes to the University of Connecticut. She was jogging last fall. She tripped, hurt her foot, went to health services on campus. You're going to get a cash benefit for that, the initial diagnosis. I had to go get her because she had broke her foot. I brought her to a local orthopedic here in Rhode Island, and they diagnosed her again with a broken foot, so she needed appliances. There's an appliance benefit. There's a benefit just for being diagnosed with a broken foot. So all in all, there's about $700 that she got back.
But specifically a broken foot, an accident, as
Right.
opposed to if she got the flu or some
Correct.
other sickness, the policy wouldn't kick in that scenario,
Right,
right? What are
right.
some of the other types of coverage?
So the other types of coverage too, there's another is a cancer policy, for instance. And cancer works the same way. It gives you actually coverage if you're, depending on the services that are treated. So if you're diagnosed with cancer, you have a chemotherapy benefit, a radiation benefit, hospitalization, surgical benefit, and so forth.
You talked to me about potentially money to pay for travel, like if you had to go to Johns Hopkins or
Right.
something like that where there was overnight travel, it might provide money for things like that.
Right, if the facility is more than 50 miles from your house, there's a transportation allowance. So in that case, if you're diagnosed with prostate cancer, my doctor says, yeah, Johns Hopkins, Maryland's the best place to go, I want to go there. So in that case, you'd max out, you get $1,500 for transportation allowances back and forth to Johns Hopkins.
But ultimately, the decision about what you use the money for is up to you. You get a transportation allowance, but if you decide to use it to buy food, there's no
Right.
restriction.
No
regarding
restriction,
that,
right. You could go on a cruise even, or buy a car to help you with the transportation back and forth, to places. We had people do that too.
I see. One of the ones I want to ask you about is short-term disability, because Rhode Island's kind of unique in the sense that we have a TDI program that's sponsored by the state. Where does short-term disability fit in? Does it make sense for Rhode Islanders? And so what is the short-term disability policy, and how does it fit in Rhode Island, or say in a state where they don't have a TDI plan like
Right.
we do?
And you're absolutely right. So Rhode Island, we're fortunate to have TDI in this state. We're one of 5 states in the nation that actually have it. And with Rhode Islanders, the Rhode Island plan, basically you max out at $752 a week, plus you also get a dependency allowance too if you have children and so forth. But if that's not enough for some people, you can get, again, through supplemental insurance, you can get additional short-term disability to make up at least 70% of your income. Because for some people, that might not be enough to meet expenses and so forth.
Okay.
So disability is out there, again, which is a nice benefit because you can cover those monthly expenses and so forth, whether you're sick.
So depending on the type of insurance, like traditional major medical insurance is often, not always, but often provided via an employer. Same thing sometimes with life insurance, but other coverage, home and auto usually get directly through an agent. Life insurance you often get directly through an agent. Where does the supplemental health insurance come in? Is that the kind of thing where you contact the company directly, contact an agent directly? Is it offered through employers? What's the marketplace look like?
So the marketplace, by far, it's really offered through employers instead. You can buy some policies direct, but by buying direct, you're going to lose that benefit of a group rate and so forth. So oftentimes, you're going to purchase it through an employer. The employer is going to offer this, in this case, any one of these supplement plans, what they feel really coincides with their own major medical and so forth. And then through that, people will be able to purchase what they feel is best needs. They have a history of cancer in the family and so forth. My sister passed away from cancer. I'm going to get the cancer plan because I know it's in my family history
So
together.
if this is the kind of coverage I want, is it worth talking to your employer and saying, hey, is this available through you guys? And if not, is it something that we can look at? Because I think that brings me to my next question, which is, who's paying for this? Is this a cost for the employer, or is the employee picking up the
That's
tab?
another great question. The employee actually will pick it. The employer can sponsor it if they want to, but for the most part, the employee is going to pay for these plans and so forth. And the other nice thing is the employer isn't out any money either, because it's billed in the arrears by AFLAC after the deductions have already been made. Another nice benefit too is some of these plans can be done on a pre-tax basis. So by doing it on a pre-tax basis, you're not only saving the employee money, but you're also saving the employer money too by not.
So this is the kind of thing an employer can bring in, utilize it as a benefit. It's optional for the employees whether they want it or not. It's not going to cost them anything.
Correct.
So it might be worthwhile for people that are interested to talk to the employers and see if it's available or see if it's something they can look at. My last
Absolutely.
question for you, I'm curious, can anybody get this coverage? And I guess what I'm asking is, what's the underwriting process like? Is there an underwriting process? Can anybody sign up for it? How difficult is it to get?
So it's fairly simple to get and so forth. There are some underwriting questions that accident plan explain about, no underwriting and so forth, because everybody gets into accidents. But like with the cancer plan, with critical illness and so
I
forth,
presume you can't already have cancer to get that.
Right. You have to be in some plans, and that's another thing that consumers should look at. In some plans, they have to be cancer-free for 5 years. Other plans might have to be cancer-free for 10 years and so forth.
So it really depends on the coverage then.
Correct. Exactly.
All right, Rich, I'm going to have to hold you there. Thank you for that information. If you'd like more information on supplemental health insurance, check out our website at foxprovidence.com. Look for the Money Pros. You can also send us a question. Find us on Facebook, tweet at us, or send me an email, moneypros@foxprovidence.com. We'd love to hear from you. Up next, spring cleaning your personal finances. Warm weather is right around the corner. What can you do to clean up your personal finances as spring breaks upon New England? All that and a lot more right here on the Money Pros. So stay with us. Welcome back to the Money Pros. Spring has sprung on New England, or at least it's making its way into town, hopefully. And in addition to cleaning out your garage and getting fertilizer on the lawn, there's something you can do related to your personal finances, and that's spring clean your personal finances. Now, I know the question you're going to ask is, why in the world would I want to spring clean my personal finances? And my answer is because according to survey after survey, people are not happy with their financial situations. Let's take a look at a slide. This information is provided to us by Wells Fargo, and it says Americans are not happy with their financial health. 44% say financial health is good or great. That means that 56% of people are not satisfied with the state of their finances. Next. 40% report not enough emergency savings. If you don't have enough money to get by in an emergency, you're going to have serious problems running up credit card debt, a number of other things. And finally, 42% have no budget or financial plan. So I think it's fair to say that most Americans are not well prepared financially. That's why we do this show. Hopefully you tune in and you learn something every week. But what are some things you can do this spring? Tax season is just ending for us. You've had your personal financial documents out. You've been examining things. Now is a great time to do a few things. So let's go through a list. I'm going to throw up a slide here. And the first thing is take a look at your spending. When we say create a budget, that doesn't mean you have to say, all right, we're only spending $100 a month going out to dinner and we have to stick to that. We just want you to look at how much you spend in a variety of categories. Review your spending, and now is a great time at the beginning of the year to look at what your spending was like last year and see where you may want to make some changes. Next up, here's an easy one. Shred some financial documents. Do you have old tax returns laying around? Do you have receipts from 1997 still stuffed away? Do you still have statements from a bank account that's been closed for 10 years? This is stuff that you need to get rid of. It's easy to shred it. Go out to Staples, buy a shredder, take it to a shredding place, call a shredding place up, they'll come to you. Take advantage of one of the many community opportunities where you can bring your stuff and get it shredded. It's easy, and it's a great way to protect against identity theft and to clean out that closet, which is something you're doing as part of your spring cleaning anyway, right? And finally, rebalance your portfolio. For those of you that are invested in the stock market, you saw significant returns. The S&P 500 was up over 30% in 2013. That means that whatever portion of your portfolio is invested in the stock market is now a significantly bigger portion of your portfolio than it was at the beginning of 2013. So take an opportunity to rebalance, sell off some stocks, and go back to some bonds. And I skipped number 3, Eric is reminding me, and that is check your credit report. You can go to annualcreditreport.org and you can get a actually free credit report. It's the federal government sponsored website. Take a look, see how you can clean up your credit. So I apologize, Eric, for going out of order, but that is how you can spring clean your personal finances. So if you just take a few minutes to do that, you'll be in that much better shape going forward. All right, up next, we know kids are expensive. We're going to see exactly how expensive as we take a look at some information from Gallup. That and more coming up here on the Money Pros. Welcome back to the Money Pros. We all know children are expensive. I've got 4 of them, and I don't need any surveys or research to tell me that they cost a lot of money. Now, we know we get a lot out of our children, but from a financial planning perspective, it's important to understand what kids cost, not because you're going to decide whether to have them or not, but when you actually retire and hopefully your kids are out of the house, it's important to look at how expenses are going to change and what money is going to be required for retirement. So it's worthwhile to take a look at what kids actually cost. Now, a lot of times we look at what do children cost over their lifetime at home and things like that, but Gallup is out with a new survey that takes a look at the difference in average daily spending for households without children versus households with multiple children. So let's take a look at the graph and we'll go through the numbers. All right. No kids, household daily spending is under $100 a day. But as we proceed with 1 or more children, daily spending for household, take for example a household of 4 children, daily spending progresses up to nearly $140 per day. So a significant differential between no kids and 1 kid per day spending. And of course for children 5 or more, that spending is over $140 per day. So, we know children are expensive. It's interesting to take a look at exactly how expensive. Do you have a question about your money? We want to hear from you. If you've got a question about anything from taxes, mortgages, finance, investing, retirement planning, college savings, whatever it might be, let us know. You can find us on Facebook by looking for the Money Pros. Send us a message, ask us a question, maybe we'll handle it on the show. You can tweet at us at the Money Pros or send me an email, moneypros@foxprovidence.com. Let me know what your comment, question, concern, or interest is with respect to your money. Anything that has to do with personal finance is fair game. We want to hear from you. That's it for today's show. Thanks for watching the Money Pros. We'll look for you again next week right here on the Money Pros. Coming up on the next Money Pros, hear the details of President Obama's new retirement plan, the MyRA. We'll also be joined by special guest Rich O'Brien. He's a specialist in supplemental health insurance. And finally, now that spring has sprung here in New England, we'll take a look at ways you can spring clean your personal finances. Don't miss the next Money Pros this Sunday at 11:30 a.m. on Fox Providence.